Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help people get better returns in the stock market. We're here with Robb Fahrion of Flying V, our marketing partner and consistent host. Robb, how are you this week?
Doing great. Happy Monday, Gary, or Tuesday, whenever someone may be viewing and listening to this. How's it going for you?
Good. I'm actually in Manhattan today,
Okay,
visiting with Raji Kabaz, one of the members of Deep Knowledge Investing's board of advisors, my former partner and co-portfolio manager from Silver Arrow. So we've just been hanging out, getting some good food here in New York and working.
great. Please tell Raji I said hello.
Yeah. All right. I
Uh,
couldn't get him on this version of the five things though. We're gonna have to do that
next
another week.
time,
Yeah.
next time. I think it's only a matter of time before we have a guest or two for sure.
Yeah.
Change it up
Perfect.
on people.
Yeah.
So this week, Gary, jumping into it, a consistently inconsistent theme. The super duper inconsistent data issue. Today, we're going to be talking about fourth quarter GDP, S&P, manufacturing and services PMI. We got some updates on LVS as well. Ready to go?
Yeah, just so it's clear, the data is inconsistent. So over the next, 20 minutes or so, as Rob and I go through this week's five things, expect that I'm going to contradict myself. We're going to contradict ourselves multiple times. That's not us not knowing what's going on. It's the data really is that confused. It's something we've been pointing out every week in the month of January, and that's the theme. We're going to keep going with that.
The one thing that stuck out to me is that it almost as if it's designed to be misunderstood. So we'll carve through that and do the best we can. Point number one, jumping right into it for this week's five things. Fourth quarter GDP came in well above expectations. Gary, tell us all, is it real?
Yeah, it's not real. First of all, the number itself was startling. Fourth quarter GDP was reported, and I am emphasizing that word reported, at up 3.3%. That was above expectations of 2%. Just so you guys know, the expectation, the estimate that people have, I mean, people usually have a pretty good beat on these things, and the estimate tends to be right to within a tenth of a percentage point. If they're really, really off, 0.2%. For the analyst community to be at 2% and have the number come in at 3.3%, 1.3% higher is an error of enormous proportions. These kinds of mistakes are not made in that size. And so here's what I think is going on. First of all, the market loved the print. Who doesn't want to be in an economy that's growing? But it was entirely created by government spending. So just to give you a sense, GDP, gross domestic product, grew by about $1.5 trillion. Okay, sounds fine, right? But debt in that time, government debt grew by more than $2 trillion. Okay. So to give you a sense, and just we've talked about this before, government spending adds to GDP whether it creates value or not. If the government pays half the country to dig holes and the other half of the country to fill in holes, we've created no economic value, but all of the money that they pay people gets added to GDP. It's one of the ways that they lie to us with the economic statistics. But let's use a really good analogy here. So let's imagine, Rob, what's the average American make in income? About maybe $60,000, something like that?
Yeah, I would have guessed somewhere around there, maybe even a little bit less. Yeah,
All
50,
right.
60,000. I think you're
All
right in your
right.
wheelhouse. So
I'm estimating. And if I'm wrong, feel free to correct me in the comments.
put it
It's
in the
fine.
comments and let Gary know.
Yeah, exactly. All right. So, but let's imagine that's the case. And now let's imagine that, during a particular quarter or a particular month, you max out your credit cards and run up $20,000, $30,000 of credit card debt, right? And you get to spend all that money and you count that as income. And so you say, oh, wait, I ran up $30,000 in credit card debt this quarter. So what I have is my regular income plus another $120,000, and I'm making almost $200,000 a year, and I'm having a fantastic year. And yeah, you get to spend that money in that hypothetical example. You get to spend that $30,000, but it's not really income. It's not really production. You just run up a giant credit card bill. And so when you have GDP up by 1.5 trillion, but debt up by 2 trillion. What that's telling you is that the government is manufacturing their number. And it takes more than $1 of government spending to create a dollar of actual value here. The other thing, and this is something that Mish Shedlock, Michael Shedlock, who goes by the mononym Mish, he's our resident economist on the Deep Knowledge Investing Board of Advisors. But last year, he spent the whole year pointing out the huge difference between GDP and GDI. So gross domestic product, that is the sum total of the goods and services produced by Americans, over time has to match gross domestic income. That's the income earned by Americans, right? Production and income, they have to match over time. And what we've seen is that the GDP number is very high and the GDI number is very low. And you tell me which one you think is going to be adjusted to sort this out, right? It's going to be the GDP because people are reporting their income. So if the income is below gross domestic product, the difference in this case is well, let's just say it's something that if you and I were to do this kind of accounting in our business, it would be considered fraud. But because it's the US government, we're not going to call it fraud, right? So just for clarity, we are not accusing the US government of fraud. Fraud is the thing we are not accusing anybody of because we couldn't do this, right? You see
Is there any adjustment, Gary, based on the GDP to where, okay, what those dollars are actually being spent on, right? To where when we talk about the American consumer, okay, are they spending their money on things that may be frivolous, entertainment, etc., versus using that credit towards something else that may be looked at as an investment or some type of long-term potential?
Yeah, so what we're seeing is over the last couple of years, there's been a huge shift from goods to services. Now, some of that frivolous, maybe, I don't know, should people be spending $1,000 on Taylor Swift tickets? The answer is maybe if you have that kind of money. If you need to take on credit card debt, then maybe that's not a good idea.
Right.
But there's definitely a shift from goods to services. And, for people wondering, okay, great, you're questioning the numbers, but what does all of this mean? The answer is that with GDP this high, that strong print makes it less likely that the Federal Reserve will lower interest rates at the next meeting. It also gives some strength to the arguments being made by people saying we're heading for a soft landing, which is a reduction of inflation without a recession. Again, if Congress is going to keep throwing money at it, we will technically not enter a recession, but we will all pay for this through more inflation, right? And all of that will make it, again, harder for the Federal Reserve to pivot to lower rates, which is what the market is hoping for. The market's penciled in, I think, 6 rate cuts for this year. Each rate cut is considered 25 basis points or 0.25%. So Wall Street is pretty much expecting a reduction of rates this year by the Federal Reserve by about 1.5%. My guess on it, and it's not a guess, my estimate is that we're going to take the under on that. I think when we get to the end of the year, the Federal Reserve will have reduced rates by less than that. And if I'm wrong, it will be because we've entered a recession. And if that's the case, that's not going to be good for stock prices.
Right. Moving on, point number 2 of this week's 5 things, we're talking PCE, personal consumption expenditures. That index was below expectations. What do you have to say about that, Gary?
Yeah, so we're going to contradict ourselves. The PCE is actually telling us inflation is starting to get under control. We saw the December PCE. It's a personal consumption expenditures. That's the preferred index that the Federal Reserve looks at. That's what, Rob, that's a better answer to your question.
Right.
That reflects what people are spending money on, right? The CPI is more theoretical. The PCE is more actual. Now, that's not exactly true, but close enough for these purposes. So the number came in December at up 2.6%. The core number, which excludes food and energy, was up 2.9%. Now, that's still too high, but if you take a look at the graph that we have on the written version of the 5 things, which you can find on the website, you can see that that number really has been sliding. And for a long time, the core number was very sticky, but it started to come down really consistently the last few months. And so the conclusion here is that all of that is going to make it more likely that the Fed pivots to lower interest rates. And I realize that contradicts what I just said before, but the data is inconsistent. Now, I don't think this happens at the next meeting, but lower inflation, particularly on the Fed's preferred index, puts more pressure on the Fed to cut rates. The one thing I'd add to this is there's been a debate over the last few years on what caused the inflation, what caused inflation, that we've seen over the last couple of years. And the government and certain pro-narrative people have insisted that what caused inflation was supply chain disruption when the world shut down due to COVID. And my assertion is, had that been the case, we'd see prices come back down to where they had been previously. And the fact that they haven't tells you that what really happened here is it wasn't temporary supply chain disruptions. It was actually the fact that the government was engaging in Ben Bernanke's preferred method of managing the economy. They called him Helicopter Ben. And at one point, he actually talked about you could stimulate the economy by printing a whole bunch of money and tossing out of helicopters, which is what the government actually tried. We did $6 trillion of COVID-related expenditures. So for everyone who got those stimulus checks, it felt really good. You got there, you're like, great, free money. Who doesn't like free money? Rob, do you like free money?
Love it.
Right, terrific. Okay, but I'm going to point this out. How much were those checks? What, $1,600, something like that for?
Yeah, I don't know. Was it 1600? I thought mine came in a little bit lower than that. I'm gonna have to call somebody.
All right. I think one of those checks came in at 1,600, another one a little lower. Okay, fine. Well, but let's say you get $1,600, but your monthly expenses go up by $200 a month. Higher rent, higher fuel, higher food costs, right? And again, I keep hammering these food costs every week. They are not up 1 point something percent. They're not up less than 2%.
Close.
Not
Yeah.
even close, right? And so, if you get a $1,600 check, you think, great, free money. But if your expenses, your household expenses go up by $200 a month, well, that's $2,400 a year, every single year, right? So basically, what the government did was they gave us all free money, and they're charging us for that free money through inflation.
Right.
And that's what we have right now. And so, that's why I'm skeptical. Had the issue been supply chain disruption, prices would have come back down. And, people were excited about this PCE print, but I'm going to point out that core number was still up 2.9%. Now, is 2.9% an awful number? It's not great. It's not awful. It's getting better. People were excited that it's getting better. But the point is, prices keep going up every single month. Prices keep going up year over year. And that's because we've printed so much money, and the government is spending huge amounts of money, and they're basically spraying money into the economy, right? And it's a simple calculation. More dollars chasing the same amount of goods leads to higher prices. And that's what we have here.
Yep. I think the average person, everybody's feeling that right now. Point 3, moving to the PMI, Purchasing Managers Index, better than expected, still in contraction, but we did have a bit of an improvement.
Yeah, and this one, now we're going to contradict what we were just talking about, right?
I'm trying to follow here.
I know. And you know what? We're also going to contradict ourselves from last week, Rob. Last week we talked about, I think it was the New York manufacturing number that was bad. It was negative 40 something. The number was so bad that it was worse than the manufacturing index number that we'd gotten during the great financial crisis of 2008, 2009. That's how bad it was. It was worse than the numbers that we'd seen during the COVID lockdowns, right? I mean, it was a horrendous number. But last week we get this PMI number, the Purchasing Manufacturing Index number, and it actually was pretty decent, right? The manufacturing output index, 48.7. Anything under 50 indicates contraction, but it was above expectations of 47.7. The services number, 52.9. So anything above 50 means it's growing. That was a 7-month high and was above expectations of 51.0. So I know that's a lot of numbers. The point is, the bad number wasn't that bad. The good number was pretty good. Both numbers were better than expectations. And it's the first, we've talked about upstream and downstream numbers a lot the last few weeks, right? The consumer is spending a lot, and seeing a lot of inflation. But if you go further up, the manufacturers, the people who are running businesses have been reining things in. And this is the first time in the last, 6 or 7 months, we've actually seen a manufacturing index coming in with pretty decent numbers. Now, because today's theme is what did we call it? The super duper inconsistent data,
Super-duper. Yeah,
right?
we're
Inconsistent
running
data
out of
issue.
adjectives.
Right, exactly. So the PMI is put together by S&P, right? Standard and Poor's, S&P Global. Their commentary was unintentionally hilarious. I'm actually going to read some of this to you. And for the people listening to this, I would just ask you, can you figure out if they think prices are going up or going down? If they think the economy is getting better or worse? This was from one paragraph of the report. It says, inflationary pressures cooled as input prices rose at a softer pace. Goods producers saw a sharper uptick in cost burdens. The pace of manufacturing input cost inflation picked up to the steepest since April 23 amid challenges. What in the world? So we had inflation pressures cooling, and input prices rose, but more slowly. But goods producers saw a sharper uptick, and the pace of input cost inflation, which is a fancy way of saying prices are going up, picked up to the steepest since April. What in the world is it? Is it getting better or worse?
I think the title of their report was the title of our things, or it had to be.
Yeah, and the line we've got on this in the written version is that DKI has been commenting on inconsistent data, but this is the most inconsistent commentary I've
Right.
ever seen in my life. Some of it's a split between goods and services, but this was an unintentionally funny read. Somebody wrote that and it got through edit, and at no point did anybody there say, you realize this doesn't mean anything. It is a collection of complicated words that doesn't explain any of it, and somehow that got through. Maybe that's how it got through legal, right? Maybe
Yeah.
they had clear commentary and legal said, no, you can't say anything clear. You need to
Right.
muddy this up. I don't know.
Right. Right. Oh, anything else on that note before we shift gears, Gary?
I have nothing funnier than S&P Global's commentary on this. And by the way,
Need to
I've done,
pull in their quotes every single week, I think.
you know what? And here's the thing, like I've done business with those guys. I spoke at one of their conferences a year and a half ago. I actually like them. Like I think they're good at what they do. I feel badly making fun of them, but the commentary is just so funny. How do you not do it? But big picture, it's actually a company I respect and have been happy to do business with before.
Switching gears, point number 4 in this week's 5 things, deep knowledge investing. We're talking LVS, Las Vegas Sands, and they showed a massive recovery in Asia, talking about fourth quarter.
Yeah, they had an incredible fourth quarter. So for clarity, deep knowledge investing's thesis on Las Vegas Sands is that you have a full recovery for their gaming assets in Asia. By gaming, we're talking about casino gaming, not video gaming. But they've got a full recovery, but the stock is still trading at distressed prices. So if the stock is trading, where it did during the COVID lockdowns when China, wasn't letting anybody into Macau, and every time somebody got the sniffles, they literally would test 750,000 people. There was a point where they were doing like 750,000 tests 2 or 3 times a month, right? Everything would stop, and it was just crazy. And so, the stock was trading around these levels through that. And now we have a situation where the stock hasn't moved, but we've gotten a full recovery. So let's talk about their two markets. First of all, the Marina Bay Sands in Singapore had adjusted property level EBITDA of 544 million. That is an unbelievable number. That is, my model goes back to like 2016. That's the highest number I've seen in any quarter out of that property. It is one of the most profitable buildings on the planet, in the gaming world, and this was an unbelievable number. Now, here's the caveat on that. Sands actually got lucky at the gaming tables. Believe it or not, a casino can get lucky or unlucky at the gaming tables in a particular quarter, and they got really lucky. And they made an extra, I think, $71 million. I'm doing this from memory. In the quarter on higher than expected hold, which is just, it's a fancy way of saying they got lucky. Okay. But even if you back that out, it was still a phenomenal quarter. Now, if we look at Macau operations have actually recovered to 90% of the 2018 level. They have several hotels near 100% occupancy. The mass and premium mass markets are fully recovered, which is where Las Vegas Sands makes most of its money. The premium market, the VIP market, that's a lot of revenue, but the margins aren't nearly as good on that business. And that, that's really more the business that Wynn goes after. Sands is big on the mass and premium mass market. The other thing that I would add is Las Vegas Sands has always been a shareholder-friendly company. Their former chairman and CEO, Sheldon Adelson, was famous for getting on conference calls, and he would always say, yay dividends, yay buybacks. And, he was a colorful guy, and he actually would eat ice cream on the conference calls, which was just one of the quirkiest things in the world. And he got away with it because he was genuinely loved and respected. I spoke to people who worked with him directly, and they adored him. And he was, he was a little quirky on the conference calls, but he was a brilliant man. And by all counts, just a super decent, good human being to work with. But he was really one of the most shareholder-friendly management guys around. And new CEO Robb Goldstein has continued that. In the fourth quarter, Rob, check out these numbers. Las Vegas Sands bought back more than $500 million of common stock, paid out over $150 million in dividends, and they have an agreement, which will be executed soon, to buy $250 million, another $250 million of Sands China stock. Sands China is the subsidiary that owns about 30% of the Macau operations. Basically, in the quarter, they returned or agreed to return just under $1 billion in capital to shareholders, and they now have the money. The company is cash flow positive in both of their markets.
Great news out of LVS in the fourth quarter. Point number 5, we're going to talk nuclear power. Global nuclear power generation expected to hit an all-time high next year.
Yeah. And so Rob, let's talk about the political aspects of this for a minute, because we've got something for everyone on this. Let's imagine for a minute that you are, part of the green lobby, and you're very concerned about global warming, global weirding, climate change, whatever we're calling it this week. Nuclear power is the only baseload generation, the only mass baseload generation, non-carbon option available, right? If you want people to live a decent life where they can have decent amounts of energy usage, which is the thing that is most correlated with quality of life, but you don't want to be spewing carbon into the atmosphere, nuclear is the only option. Now, if you are part of, the other part of the population that says, I'm really not concerned about this, I just want to live a better life. And there are people who don't believe in global warming and, climate, the man-made climate change, and that's fine too. But for those people, nuclear is really, once you've built it, your best, cheapest, most reliable option. And the beauty of it is, we can source that stuff here, right? As opposed to lots of the rest of the world, where if you want to burn oil or gas, we produce some of it here, but a lot of it gets sent to different places and comes from places that we might not want to support. So regardless of what your politics are, regardless of what your environmental position is, nuclear is absolutely our best option. And we are now looking at, by next year, nuclear power generation at an all-time high. And the beauty of that, from our point of view, besides the fact that it's the best way to have a secure grid, is current demand for uranium exceeds current annual mining capacity. So every year, we are going through about 20% of all uranium stockpiles. And what we have now are more plants coming on. And every time a new plant comes online, it requires to seed the plant 3 times the annual usage, right? So a new plant is like tripling the capacity of existing plants. And so it takes roughly 5 to 10 years to get a new uranium mining project permitted and operational. And so here's what we're seeing. What we're seeing is that we are going to have massive increases in demand long before we can increase supply. And so when that happens, you're going to have a huge increase in uranium prices. And in fact, Deep Knowledge Investing has had huge exposure. It is, I think, my second largest position right now is in a uranium stock that's more than doubled for us. We've made more than double our money on this in a little over a year. And I haven't sold any of it. And so, for people who are interested in how to profit from this incredible trend, feel free to reach out. We can help. So anytime you have something that's doubled and we've just been buying more of it, that's a pretty good place to be.
No doubt. And as you mentioned, Gary, left, right, good market, bad market, deep knowledge investing, our goal is to help you make money in any economy.
That's right.
Gary, any closing thoughts on this week's 5 things? I know my head's spinning a little bit, but still a lot to digest. But thanks for walking us through the inconsistencies as best as you possibly could.
Yeah, Rob, first of all, you're right. Our goal, whoever you are, is to help you make money. We don't ask what your politics are, what your environmental goals are. We'll help you make money, and then you can spend that money or donate it to charity or invest it in whatever way is consistent with your goals, right? Our job is to help you live the life that you want to live. Beyond that, we'll see. We may get more inconsistent data this week. The big news this week is going to be the Federal Reserve meeting. And so in a couple of days, Chairman Powell, Jerome Powell, will take to the stage and answer the same inane questions that he gets every one of these press conferences. They ask him the same questions 15 times, and you can actually see like the look on his face. He just gets more and more irritated. Like, are you really asking me this again? The whole thing is phenomenal theater, and we love it. Deep Knowledge Investing's prediction on this is that the Federal Reserve will keep rates unchanged. So I don't think there's going to be a change, but what everybody's going to be looking for are small changes in the language, both in the press release that's issued and also the language that Powell has used. And so, just a few months ago, he was literally talking about it in the press releases. You would see language saying, we are prepared to raise rates if conditions warrant it. That language has been taken out, and we're not going to see that again. So what people are going to be watching for is kind of the subtle changes in language, how they talk about it. I would be surprised if there weren't language saying something along the lines of we expect to reduce rates later this year. And he'll, of course, use the term data-driven, which is his way of not committing to anything, which, to be honest, if I were Powell, I wouldn't commit to anything either, right? Telling people we're going to be data-driven and thoughtful in our approach, that's not a bad way to go. But we will be, watching with intense attention to minute detail that will all change within the following 3 weeks. But it'll be important for that one afternoon, and exciting. Think about it like a sporting event, right? Like, the playoffs will be at the end of the year, but we're watching the preseason game now.
There we go. Gary, thanks as always. And for everyone watching and listening, we encourage you jump on our website, deepknowledgeinvesting.com, sign up for a free subscription, maybe even consider a premium subscription where you'll get access to up-to-date current recommendations, live real-time notifications from Gary as well. And if anything, maybe a like, comment, subscribe to us so you can be notified about this show on a weekly basis. And more than anything, just thank you for spending your time listening to us. This is Deep Knowledge Investing's 5 Things. Gary, as always, incredible job, and look forward to speaking with you next week.
Great, Rob. Thanks a lot. And for everyone watching, thanks for your time. We know it's valuable and we appreciate it. Have a good week. We'll see you next week.
Thanks, everyone.